Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today, we're going to just cover the Primary Vision Frac Spread Count. I know everyone's favorite part. And then we're just going to touch on some just high-level econ data and some recent oil news that's come out that we think is interesting. And then next week, we'll go into more depth just to kind of give you something to consider when you're looking at and watching our econ show and our EIA show that came out earlier this week. So now, without further ado, we came in at 175. So what was the 175? So we had an increase of 5, and it was really happening everywhere that we've really talked about. And in our report that came out today, we went through some reasoning on why we think this is going to continue, and it's going to be a very steady grind higher. It's not going to be this huge surge, but a very slow kind of walk up of, let's call it anywhere from 3 to 7 spreads. That's going to continue just as we see this this action taking place with, obviously crude prices sitting here right now almost at 57. There's a lot of support that's starting to come in, not just on the oil side, but also on the NGL basket. And it's something that we went through in more detail with Robert Norton on Conversations that's going to come out next week. So just thinking about, what's going to happen next. One of the things that we've talked about is the expansion overall. So when we look at what has the expansion been, we talk about the last 3 months. So you can see that steady grind back to 180, 159, back to 133, and now we're on this steady move higher. And after Liberty spoke today, the CEO said, look, we're going to have a very similar production output for December 2020 and December 2021. And that's really what we've been talking about, where they're now at a point that they're going to be able to hold the line in terms of production, which we estimate to be at about 10.9 million. But there's really no demand to see this growth. And it's going to be difficult given quality of the rock that's available, some of the positions that these companies are taking where they're trying to at least protect or at least show some form of cash flow without really just going and hitting the market for debt and others. But that's why there's going to be that slow grind. And the other thing that we talk about in our end of year report from last year, so not to give too much away, but there is also going to be a horsepower problem. And the horsepower problem is not going to happen right now, but it starts to become a concern as we get into north of 230 spreads, just because you have older equipment, things that might have been cannibalized to bring back some of these spreads so quickly. And you also have a certain age, weathered, how long were they cold stacked? Were they cold stacked properly? So that's where you're going to have to make a decision of, are you going to pay as an E&P for new spreads? And is the OFS company or the pumpers, are they going to go out and proactively order new stuff? And the answer is probably right now, no, but it doesn't mean that they won't order new parts and try to get things prepared for this run up to, let's call it 190 spreads by the end of February. So when we think about, why into the end of February, well, this is, obviously 2020 was a very strange year, but when you think about how the seasonalities normally go, we typically start to see a little bit of recovery that happens as we head into March. And one of the things that we continue to see is support on the natural gas side, support on the NGL side, natural gas being LNG. The exports remain strong, but we also do have a large amount of demand maintained in the U.S. And we do have a certain amount of associated gas that has come out with crude production sitting at 10.911 versus 13.2. So there's some of that flexibility, which is keeping some of that momentum in some of these different locations. We still see additions coming in the Bakken, but realistically, as we keep talking about, the lion's share that's going to get us to the next level will be the Permian. And right now we're seeing additions in both the Delaware and the Midland, still weighted towards the Delaware. But again, the Midland is still not something to be ignored. Now, this is just one of the components that we talk about in today's report, and we show it in different timeframes, but and also going back further. But here you can see just where the NGL bucket is, sits in general in terms of pricing. So there's still something to be gained. There's a certain amount that can be hedged. Really, NGLs are kind of capped at 6 months because then you lose liquidity. But when we talk about oil and the oil rally in general, you can hedge above 50 going through, let's call it October 2022. So not to say that somebody's going to want to lock in that price, but you can maybe find a put, you can do some sort of spread to give you some of that downside protection. But when we look at in 2021, there's as the front months continue to push higher, that opens up the opportunity for E&Ps to hedge, lock in cash flow, complete wells, work through their DUC inventory to help build back some of that production, offset some of those decline curves, and then going out there and drilling new wells to replenish some of those DUCs. And right now, the question is going to be, well, the rigs outpace the completions, and right now we think completions will continue to outweigh new wells, which will just mean that the DUC count will continue to shrink, but it's going to shrink at a slower and slower pace, just given where the activity lies. Now, when we think about U.S. activity, we really have to talk about, well, what's happening in the export market, and China was a big buyer, through December. But now when we talk, when in the report, we go through this in a bit more, we talk about the different spreads and differentials and how that's really started to weigh on what's happening in China, what's happening with U.S. exports going forward. And this is just a great snapshot done by S&P Global Platts, looking at what independent refiners or teapots bought for January out of China. And you can see that there's very little, if any, U.S. grades on here. A lot of this is coming from other locations and other blends, whether that be Europe, Middle East, Russia. So this is going to be a little concerning because China was a big side of this flow coming from the U.S. was. Now, South Korea was strong, India was strong. That we don't see India slowing down, South Korea a little bit, but China was this I'm just like anything else, this elephant in the room, and they're starting to pull back. And that's one of the things that we're going to talk about in a bit more detail over in a few moments. And when we just look at regional aggregate indicators, this is just looking at congestion, and we can see China continuing to move lower, seeing that pressure as Lunar New Year approaches. It starts next week. There's going to be a lot of limitations. The expectation is to be down 30 to 40% versus 2019, but still up 10% from last year. So there won't be as bad. But again, this is going to be a knock on just general activity, and just again, that's going to relate to oil demand, gasoline demand, diesel demand, your typical pool of assets. So then, when we just look at what came out today with U.S. non-farm payroll. As we were saying that we expected it to flatline, but we didn't expect the number to be as weak as it was. And with that being said, December was actually taken down lower than the initial. November was taken down. And then the January number really missed by a wide margin, which is just showing that there remains an employment and jobs problem. And this is what we've been talking about. And when we talk about leading indicators, because leading indicators have been saying that, look, the economy's getting a little bit better. Things are looking better. We're seeing orders pick up. We're obviously seeing those delivery delay times, which we talk about in the Econ show, but it's not turning into jobs. And this is where we talked about 100 people getting laid off, 20 people getting hired back quickly. And then another 30 taking, let's call it 6 to 12 months to close the gap as new orders come through and the company feels as though they have more margin of safety in terms of what's on the books. But 50 of those people were never going to come back, or at least not into that company. And some of them may never get work in that industry again and will have to go elsewhere. And when you look at just the shape of this chart, that's what's really starting to play out, which is why we remain cautious on what is the activity going to look like in the U.S. in general. And we had an article come out today that we wrote looking at inflation and how that's impacting the U.S. consumer in general. And then when we look at China, because again, this is kind of a big bright spot, the Chinese supertanker crude imports, we talk about this on the EIA show. We just wanted to show it again, that it moved to a new high of boats that are signaling China in general. And as we talked about on the EIA show, there's a lot of floating storage out there, and it continues to move higher in Asia. Now, India will start to draw down. South Korea is going to remain elevated. Japan will draw down some, but again, stay elevated. But this is going to be a bigger issue as it shows up, and there's just going to be a timing delay as to when it goes from the boat to onshore. And yes, they've drawn down to about both based on one of the tanker trackers and satellite companies. They've talked about how there's about 990 million barrels in storage. Well, what is this going to do? And is there going to be demand to offset some of those runs? Especially when we look at, where we see storage on refined products. We had a pretty big build in Singapore. We had pretty stable builds in Europe. We'll go through this in more detail in the economy in the EIA show segment 3, but just showing that we haven't been able to really draw down a lot of these products, even though when we look at just activity, refinery outages continue to fall. So in the EIA show, we had this. There was about 2.3 million barrels a day of outage. Now there's 3.12. Again, we just continue to see this slowdown in refining, which again is going to lead to less oil demanded, which we're seeing in the physical market in terms of some of these prices and realized prices on the physical side, while the paper market obviously is pricing in something very different. So these are some of those competing components. But with all of that being said, as long as you can hedge, and when we talk about U.S. E&Ps, as long as you can hedge, you have the capacity to store it at a reasonable price, which when you're in backwardation, you're not really being incentivized to, because you're going to try to sell it as quickly. So that's where you can lock in some of those longer term hedges. And then if you start to go into contango, you can start playing around with some of those deliveries and what can happen in general. And again, these are things that are going to continue because, as we said in the EIA show, the U.S. refiners are going to continue to operate between 82 and 83%. So we will get a little bit more pull through from storage into our refiners. We'll see an increase into imports. And then next week, we're going to talk about some of the increases in OSPs, or official selling prices, from Saudi Arabia, because they've increased prices, but Europe wasn't buying as much. The US was buying a little bit more. And then when you look at the price increases, you have to look at it on what are the differentials normally. And they're really not too far, at least coming to the US, away from average. So even though it is an increase, it's really not a huge shock given where things sit. So again, these are things that we're going to have to tease out and look at, because the market remains fluid. There's a lot of optimism in it. If you just look at where futures are, and E&P is going to have the opportunity to take advantage of that and try to layer on some of those hedges. So thanks again for watching. We'll put out this and then some of the other shows so that you can we did a lot of work this week, so you can look at it at your leisure. Hopefully everyone has an enjoyable weekend and you're not sitting under a pile of snow like we still are in the Northeast. But thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.